3 weeks ago, a phone call came in that I wasn't expecting. It wasn't from a journalist. It wasn't from a colleague in finance. It was from someone I hadn't spoken to in more than a decade, a former senior official who spent years deep inside the U.S. financial system, the kind of person who understands how money really moves behind the scenes. When I answered the phone, he didn't say hello. He didn't ask how I'd been. The very first thing he said was a question. How much cash do you have outside the banking system right now? I told him the number. Then the line went quiet. Not the kind of pause you get when someone is thinking of what to say next. The kind of pause that feels heavy. After a few seconds, he finally spoke again. And what he said next is the reason we're having this conversation today. He said, "You should probably double it before April." Now, when someone with that kind of experience says something like that, you don't ignore it. You ask why. Because people who have spent decades inside the financial system rarely make warnings like that casually. They know how markets behave, how banking systems function, and more importantly, how financial stress tends to build long before the public ever notices it. What made this moment even more striking was the calmness in his voice. There was no panic, no drama, just quiet certainty. And that's usually how the most serious financial warnings sound: calm, direct, and very specific. Since that call, I've spent weeks digging into the data behind what he might have been referring to, looking at bank balance sheets, looking at government debt numbers, looking at credit markets and commercial real estate. And what I found is something that retirees especially need to understand right now, because the risks inside the financial system today don't necessarily look dramatic on the surface. The stock market is still near historic highs. Economic headlines talk about growth, artificial intelligence, and strong employment numbers. Everything appears stable, but financial stress rarely begins where everyone is looking. It starts quietly in the plumbing of the financial system. And when those pressure points build long enough, they can turn into sudden problems very quickly. The question isn't whether the banking system will disappear tomorrow. That's not how financial stress usually unfolds. The real question is whether individuals, especially retirees who rely on savings and fixed income, are positioned safely enough if markets become unstable again. And that's exactly what we're going to break down today, because there's a specific reason some financial professionals are quietly advising people to think carefully about how much money they keep inside the banking system and how much they keep accessible outside of it. Today, we're going to talk about something that doesn't get nearly enough attention in retirement planning conversations: the structure of the banking system itself and how retirees can protect their savings if financial conditions change. This isn't about fear or panic. It's about understanding how the system works and making sure your financial life is structured in a way that gives you flexibility and security no matter what happens in the broader economy. Over the next few minutes, I'm going to walk you through several important things. First, we'll revisit a banking event from 2023 that many people remember only from the headlines, but very few people truly understood. Then, we'll look at some of the hidden pressures that still exist in parts of the financial system today, including issues tied to interest rates, commercial real estate, and government debt. After that, we'll talk about the early warning signals financial professionals tend to watch when stress begins building in the system. And most importantly, we'll discuss a practical question that many retirees have been asking lately. How much money should you realistically keep outside the banking system so you're prepared if markets become unstable? Because here's something many people assume that isn't entirely accurate. A lot of Americans believe that as long as their money is sitting in a bank account, it's automatically safe no matter what happens. And while the banking system has strong safeguards, there are still important limits and mechanics that every depositor should understand, especially if you've spent decades building retirement savings and you want to protect that money carefully. So, before we talk about what actions might make sense, we need to go back for a moment to something that happened in March of 2023, because that event revealed a weakness inside the banking system that many people are still overlooking today. To understand why some financial professionals are paying closer attention to banks again, we need to revisit what actually happened in March of 2023. Most people remember the headlines. A major bank collapsed almost overnight. News coverage described it as a sudden crisis. Regulators stepped in over a weekend, and within days, the story faded from the front pages. For many Americans, the takeaway was simple: a single bank failed. The government stepped in, and the problem was contained. But the deeper story is much more important than the headlines suggested. Because that bank didn't collapse due to fraud or reckless lending like we saw during the housing crisis of 2008. The issue was something far more basic and far more widespread inside the banking system. It had to do with interest rates and the value of bonds. During the years when interest rates were extremely low, banks across the country purchased enormous amounts of long term government bonds and mortgage backed securities. At the time, those investments seemed perfectly safe. Interest rates were near zero, the economy was stable, and government bonds are generally considered one of the safest assets a bank can hold. But then the Federal Reserve began raising interest rates at the fastest pace in more than 4 decades. And when interest rates rise quickly, something important happens to existing bonds. Their market value falls. A bond paying 2% interest becomes much less attractive if new bonds are suddenly paying 5%. Investors simply won't pay full price for the older bond anymore. That shift caused the value of many long term bonds held by banks to drop significantly. On paper, some banks were suddenly sitting on very large losses in their bond portfolios. Now, normally those losses remain mostly theoretical because banks can hold bonds until maturity and eventually receive their full value. But that only works if depositors leave their money in place. The moment depositors begin withdrawing funds quickly, the bank may be forced to sell those bonds at the lower market value to raise cash. And that's exactly what happened. Within roughly 48 hours, depositors moved billions of dollars out of the bank using online transfers and mobile banking apps. The speed of modern banking turned what might once have been a slow problem into a rapid crisis. Regulators stepped in, took control of the institution, and guaranteed deposits to prevent panic from spreading. On the surface, the crisis was contained, but the event revealed something that financial analysts immediately noticed. The bond losses that caused the problem weren't unique to one bank. They existed across many banks in the system. In fact, official banking data showed that financial institutions across the United States were collectively holding hundreds of billions of dollars in unrealized losses tied to bonds purchased when interest rates were far lower. Again, these losses don't necessarily create immediate problems. They sit quietly on balance sheets unless the bank is forced to sell those assets. But they represent a vulnerability. Think of it like a pressure point in the system that usually stays hidden until something forces it into the open. And that brings us to the second area of concern that some financial analysts are watching closely right now because bonds aren't the only potential stress point sitting inside the banking system. Another sector, one that receives far less attention in everyday news coverage, is commercial real estate. Over the past few years, the way people work has changed dramatically. Remote and hybrid work arrangements have become permanent for many companies, and that shift has had a profound effect on office buildings across major cities. In places like San Francisco, Chicago, and New York, office vacancy rates have climbed to levels that would have seemed almost unimaginable a decade ago. Entire floors of buildings sit empty. In some districts, nearly a quarter of office space is unoccupied. When office space sits empty, building owners collect less rent. And when rental income falls, the value of those buildings declines. That's where the banking system comes into the picture again. Many commercial buildings were purchased or refinanced during years when interest rates were extremely low. Property owners took out large loans based on the expectation that rents would remain stable and borrowing costs would stay manageable. But today, the math looks very different. Higher interest rates mean refinancing those loans can become much more expensive. At the same time, reduced demand for office space means some buildings simply aren't generating enough income to support the debt attached to them. Over the next couple of years, a very large number of commercial real estate loans will reach their maturity dates. At that point, owners must either refinance the loan or repay it. If refinancing becomes too expensive or the property value has dropped significantly, defaults can occur. And here's the detail that often gets overlooked. A large portion of these commercial real estate loans are held not by the largest global banks, but by regional and mid-sized banks across the country. The same category of institutions that rely heavily on customer deposits to fund their operations. That doesn't mean a wave of bank failures is guaranteed. Financial systems are complex, and regulators actively monitor these risks. But it does mean that banks are navigating a challenging combination of pressures. bond portfolios that declined in value when rates rose, and commercial real estate loans facing uncertainty as the office market adjusts to new realities. When analysts look at these two factors together, they start asking a very reasonable question. If financial conditions tightened further, where might stress appear next? And the answer to that question leads us to something even bigger that affects the entire financial system, not just individual banks. Because the banking system doesn't operate in isolation. It sits inside a much larger financial ecosystem shaped by government borrowing, interest rates, and global demand for U.S. debt. And when those forces begin shifting at the same time, the ripple effects can spread much further than most people expect. To understand why those ripple effects matter, we have to zoom out and look at something even larger than the banking system itself. We need to look at the financial position of the U.S. government. Because the government's borrowing needs influence interest rates, liquidity in financial markets, and ultimately the environment banks operate within. Right now, the United States carries a national debt that has grown to levels few people truly grasp. The total figure is measured in the tens of trillions of dollars. But a number that large can feel abstract, so it's more useful to focus on something simpler: the interest payments required to service that debt. Every year, the federal government must pay interest on the money it has already borrowed. And as interest rates rise, those payments increase. In recent years, the annual interest cost has climbed to levels exceeding $1 trillion. That means the government is now spending more on interest than on many major programs. Why does this matter for banks and depositors? Because when the government needs to borrow large sums of money, it does so by issuing Treasury bonds. Those bonds must be purchased by investors. Historically, a significant portion of that demand came from foreign governments and international institutions. Countries that ran trade surpluses with the United States often recycled their dollars by buying U.S. Treasury securities. For decades, that system helped keep interest rates relatively stable. But global financial dynamics evolve over time. Some countries have reduced the pace at which they accumulate Treasury bonds. Others are diversifying their reserves into different assets. When foreign demand becomes less dominant, more of the government's borrowing must be absorbed by domestic investors. That means American financial institutions, banks, pension funds, insurance companies, and money market funds play a larger role in purchasing government debt. In simple terms, the financial system increasingly lends money to the government. And when massive amounts of capital flow into government bonds, that money is no longer available elsewhere in the economy. It's not being used for business loans, mortgages, or new investments. It becomes tied up funding federal deficits. Economists often describe this as a crowding out effect. The government's need for financing competes with the private sector for the same pool of capital. And when competition for capital increases, borrowing costs tend to rise across the economy. That brings us back to banks again. Because banks operate at the center of this financial ecosystem, they depend on stable funding, predictable interest rates, and confidence among depositors. When the broader system experiences tightening liquidity or higher borrowing costs, banks feel that pressure in multiple ways at once. And there's another major factor that has quietly been shaping financial conditions in recent years. During the pandemic era, the Federal Reserve took extraordinary steps to stabilize the economy. One of those steps involved purchasing enormous quantities of government bonds and mortgage-backed securities. By buying these assets, the Fed injected liquidity into the financial system and helped keep interest rates extremely low. Over time, the Federal Reserve's balance sheet expanded dramatically. But in the years that followed, the Fed began reversing that process. Instead of adding liquidity, it started gradually reducing its balance sheet. This process is known as quantitative tightening. Rather than buying bonds, the Fed allows them to mature without replacement, effectively pulling liquidity out of the financial system. Imagine a vast reservoir of money slowly draining. It doesn't create an immediate shock. Instead, the level gradually falls over time. When you combine this liquidity drain with the government's large borrowing needs and higher interest rates across the economy, the result is a financial environment that is significantly tighter than it was just a few years ago. Now, tightening conditions don't automatically cause crisis. Financial markets go through cycles and the system often adapts. But historically, Periods of tightening liquidity tend to reveal hidden weaknesses in certain sectors. Sometimes those weaknesses appear in housing markets, sometimes in corporate debt, sometimes in banks themselves. What makes these periods difficult to predict is that stress rarely begins with a dramatic headline. It begins quietly in corners of the financial system most people never watch. For example, stress can appear in the short term lending markets where financial institutions borrow from one another overnight. It can appear in corporate bond markets when investors demand higher compensation for lending to riskier companies. It can even appear in the stock prices of regional banks, which sometimes start declining months before the public realizes there is a deeper issue developing. Financial crises almost never start with a sudden explosion. They begin as a slow drip, a few small signals here and there, a market moving in an unusual way, a sector underperforming quietly. Then eventually, something happens that forces everyone to notice at once. That's why experienced investors and analysts spend so much time watching early indicators, not because they can predict the exact timing of events, but because certain signals have historically appeared before major financial disruptions. And there are three signals in particular that many professionals monitor when they're trying to determine whether stress in the system is increasing or fading. When experienced investors try to understand whether financial stress is quietly building beneath the surface, they often focus on a handful of indicators that historically move before major disruptions. These signals don't predict the future with perfect accuracy, but they help reveal when the financial system is becoming more fragile. Think of them like pressure gauges on a complex machine. When the readings start climbing into dangerous territory, it tells you the system may be approaching a breaking point. One of the most closely watched indicators is the yield on the 10-year U.S. Treasury bond. This number represents the interest rate investors demand to lend money to the U.S. government for 10 years. Under normal circumstances, that rate moves gradually as inflation expectations, economic growth, and global capital flows change. But when the yield rises sharply or pushes above key psychological levels, it can send shockwaves throughout the financial system. Why? Because the 10-year Treasury yield acts as a benchmark for countless other interest rates across the economy. Mortgage rates, corporate borrowing costs, and even stock market valuations are influenced by it. When that yield rises significantly, borrowing becomes more expensive for businesses and consumers alike. At the same time, higher yields can put pressure on the bond portfolios banks already hold. Remember those long-term bonds that lost value when interest rates climbed? If yields move even higher, those losses deepen further. That's why analysts watch the 10-year Treasury yield so closely. If it climbs and stays above certain levels for an extended period, it can signal that the bond market is demanding greater compensation for risk. And when the bond market begins sending distress signals, the effects can ripple quickly through the rest of the financial system. The second signal many professionals monitor involves regional banks themselves. Specifically, analysts watch how investors are pricing the stocks of smaller and mid-sized banks. These institutions play a crucial role in lending to local businesses, commercial real estate developers, and communities across the country because they are more exposed to certain sectors of the economy. Their stock prices can sometimes act like an early warning system. When investors begin to worry about potential losses on loans or balance sheet vulnerabilities, bank stocks often react before the broader public notices anything unusual. A sustained decline in regional bank stocks can indicate that investors believe those institutions may face rising risks. Again, this doesn't automatically mean banks are failing. Markets sometimes overreact, but historically sharp and persistent drops in regional banking stocks have preceded periods of financial stress. That's why professionals keep an eye on indexes and exchange-rated funds that track regional banks. They provide a window into how the market is assessing the health of that sector in real time. The third signal appears in a part of the financial system most people rarely hear about, the credit markets. When corporations need to borrow money, they often issue bonds. Some companies have strong balance sheets and high credit ratings, while others carry more risk. Investors demand higher interest rates to lend to those riskier borrowers. The difference between safe corporate bonds and riskier ones is known as the credit spread. In stable economic environments, credit spreads tend to remain relatively narrow. Investors are confident, liquidity is plentiful, and companies can borrow at reasonable costs. But when stress begins building in the financial system, investors demand higher compensation for taking on risk. Credit spreads widen. Borrowing becomes more expensive, especially for companies with weaker finances. When spreads widen dramatically, it can signal that lenders are becoming cautious and liquidity is tightening. That tightening can ripple through the entire economy. Companies that rely on refinancing debt may struggle to do so. Investment slows, defaults can begin rising. In past financial crises, widening credit spreads were often one of the earliest visible signs that something deeper was happening beneath the surface. Now, here's the important point. None of these signals alone guarantees a financial crisis. Markets move for many reasons, and sometimes these indicators flash warnings that never turn into major disruptions. But when several of them begin moving in the same direction at the same time, analysts start paying much closer attention because that combination can suggest that financial conditions are tightening faster than the system is comfortable handling. And that brings us back to the practical question many retirees have been asking. If the financial environment becomes more uncertain, how should individuals think about the safety of their savings? Should money remain entirely inside the banking system? Should some of it be kept elsewhere for flexibility and peace of mind? These questions have become more common since the banking disruptions of recent years. And the answer isn't about panic or withdrawing everything from banks. It's about something far more practical: financial resilience. In the next part, we'll talk about the specific guideline many financial planners recommend for retirees and families who want to make sure they can access funds easily, even if markets become volatile or financial institutions experience temporary stress. Once you understand how financial stress can build in the system, the natural next question becomes practical rather than theoretical. What should individuals actually do with their own money, especially retirees who depend on savings, pensions, or investment income to support their daily lives? The goal here is not to predict the exact timing of financial events. No one can do that consistently. Instead, the goal is to build a financial structure that allows you to remain calm and flexible no matter what happens in the broader economy. One of the most widely recommended principles among financial planners is maintaining a liquidity buffer, money that is easily accessible without relying on the stability of markets or financial institutions. This idea isn't new. In fact, it has been a cornerstone of conservative financial planning for decades. But the events of recent years have reminded many people why it matters. Because during periods of financial stress, access to liquidity becomes incredibly valuable. It allows you to pay expenses, handle emergencies, and avoid selling investments at the worst possible moment. Imagine a scenario where markets suddenly drop sharply, or a financial institution temporarily freezes withdrawals while regulators sort out a situation. These events are rare, but they have happened before. If all of your money is tied up inside the system at that exact moment, your options can become limited. On the other hand, if you have a portion of your savings available outside those channels, you have time.